On August 25th, 2025, the United States government did something it hasn't done in over 60 years. They officially classified silver as a critical mineral for national security. Not a precious metal, not an investment vehicle. A critical mineral, the same designation reserved for lithium-powering electric vehicles, cobalt in military equipment, and rare earth elements controlling our defense systems. Think about what that designation actually means. Our government doesn't hand out national security labels to shiny objects people like to collect. They reserve that classification for materials so vital to American infrastructure, manufacturing, and military capability that losing access would fundamentally threaten our economic security and defense readiness. Here's where it gets interesting. For 6 decades, our government took the exact opposite stance on silver. From the 1960s through the early 2000s, the U.S. liquidated its entire strategic silver stockpile, every single ounce we held in reserve, dumping over 5 billion ounces onto global markets. We treated silver like a relic of the past, something we didn't need anymore, just a decorative metal taking up space in government vaults while we moved toward a modern economy. But something changed. Something our government sees now that they didn't see before, or chose to ignore until the risk became too severe to overlook. Since that August designation, approximately 75 million ounces have quietly flowed into U.S. government vaults and strategic reserves. Federal purchasing programs you probably never heard about have begun accumulating silver month after month. No press conferences, no announcements to the general public, just systematic, methodical buying that accelerated the moment silver received its new classification. Now, let me put that number in perspective. 75 million ounces sounds abstract until you realize our entire market has suffered 5 consecutive years of deficits totaling 800 million ounces. That's nearly 1 full year of global silver supply, just gone, evaporated from above-ground stocks while demand keeps climbing and new supply struggles to keep pace. You might be wondering, if we're running such massive deficits, where's all the silver going? Who's consuming it faster than miners can pull it from the ground? The answer explains why our government reversed 60 years of policy overnight. Industrial demand consumed over 1.2 billion ounces of silver in 2024 alone. Not jewelry, not investment coins. Industrial applications, the kind that keep our economy functioning and our military operating at full capacity. Every solar panel converting sunlight into electricity needs roughly 20 grams of silver. Each electric vehicle rolling off production lines contains about 50 grams spread across electrical contacts, battery management systems, and power distribution networks. Your smartphone screen, your laptop touchpad, your smart home devices all depend on silver's unmatched electrical conductivity. But here's what should grab our attention. The technologies driving our future economy require exponentially more silver than the devices we use today. AI data centers, the massive facilities processing artificial intelligence workloads and training large language models, are silver gluttons. A single 500 megawatt data center requires 300 metric tons of silver for power distribution systems, cooling infrastructure, and the solar arrays many facilities use to offset energy costs. According to projections from industry analysts tracking data center construction, AI infrastructure alone could add 5 to 10% to total silver demand over the next 3 years. That's not replacing existing uses. That's entirely new consumption stacked on top of everything else, competing for the same limited supply. Now, think about our defense systems for a moment. Missile guidance systems rely on silver-coated contacts for split-second electrical precision. Radar systems use silver-coated waveguides to transmit and receive signals without degradation. Military aircraft electrical systems depend on silver's reliability in extreme conditions, where failure isn't an option. When the Pentagon looks at silver supply chains, they see a vulnerability, a potential weakness that adversaries could exploit. And here's the uncomfortable truth our government finally acknowledged. We don't control our own silver supply anymore. The U.S. now imports 64% of the silver we consume every single year. More than half of what we need to keep our economy running comes from other countries, including nations we may not always see eye to eye with on trade policy or geopolitical strategy. Nearly 25% of our imported silver comes from Mexico alone. One country, one neighboring nation that supplies a quarter of. The silver flowing into American manufacturing plants, defense contractors, and technology companies. The U.S. Geological Survey, the agency responsible for tracking critical mineral supplies, internally refers to this dependency as a low probability but high impact disruption scenario. Let me translate that bureaucratic language for you. Low probability means they don't expect our silver supply to get cut off tomorrow morning. High impact means, if it ever does happen, through trade disputes, political instability, natural disasters, or deliberate economic warfare, the consequences would devastate American manufacturing, cripple defense production, and potentially halt the AI infrastructure build-out that every major tech company and government agency considers essential to maintaining our global competitive advantage. You're probably thinking, if silver is so critical, why didn't we see this coming? Why did our government wait until 2025 to act? The answer lies in how our economy evolved over the past 2 decades. 20 years ago, we used silver primarily in photography, jewelry, and silverware. Those applications were important, but not strategically vital. You could substitute other materials or simply do without if supply became tight. But the clean energy transition, the electronics revolution, and now the AI boom fundamentally transformed silver from a luxury commodity into an industrial necessity. Solar installations grew from niche applications to mainstream power generation. Electric vehicles went from experimental concepts to mass-market products. Smartphones evolved from executive accessories to devices literally billions of people depend on for communication, work, and daily life. Each technological leap increased industrial silver consumption. Each innovation created new applications where silver's unique properties, the highest electrical conductivity of any metal, the highest thermal conductivity, the best reflectivity of visible light, made it irreplaceable with current technology. According to data from the Silver Institute tracking industrial applications, electrical and electronic silver consumption surged 51% just since 2016. That's less than a decade, and we've seen demand more than double in the sectors driving our modern economy. Meanwhile, global silver production barely budged. Here's why. Over half of all silver comes out of the ground as a byproduct of copper, zinc, and lead mining. Companies dig for those base metals, and silver tags along as a secondary benefit. When silver prices rise, those mining operations don't suddenly produce more silver. They produce the same amount of copper or zinc they plan to extract, which yields the same amount of silver regardless of how valuable that silver becomes. New primary silver mines, operations specifically designed to extract silver as the main product, take years to develop. You need to discover deposits, conduct feasibility studies, secure financing, obtain permits, build infrastructure, and then actually start production. Industry experts estimate addressing supply imbalances through new mining projects could take the better part of a decade. That's the mathematical trap our government finally recognized. Demand growing faster than supply. New supply constrained by geological realities and long development timelines. Import dependency exposing us to supply disruptions we can't control, and strategic competitors who understand these same dynamics and are making their own moves to secure silver before scarcity becomes crisis. Our government's August 25th decision wasn't about precious metals markets or investment opportunities. It was about national security, acknowledging that silver scarcity could compromise our technological edge, our defense capabilities, and our economic competitiveness just as surely as losing access to rare earth elements or running short on semiconductor manufacturing capacity. The critical mineral designation changed everything. Federal agencies now have mandates to secure strategic silver reserves. Permitting processes for domestic silver mining projects get fast-tracked. Tax incentives flow to companies developing American silver production. And perhaps most importantly, government purchasing programs, with budgets most retail investors can't even comprehend, entered the market as permanent buyers competing for every available ounce. That's the setup. That's why 75 million ounces have already disappeared into government vaults while our markets keep running deficits year after year. But here's what you really need to understand. We're not the only ones who figured this out. Other governments, particularly the ones who actually control silver production, are making their own strategic moves. And when you see what China has been quietly doing in silver markets over the past 18 months, you'll understand why our government's August decision might have come too late to avoid the supply crisis already forming on the horizon. Let me show you exactly what China has been doing, because the numbers tell a story our financial media isn't covering. In 2024, China increased its silver ore purchases by 31.46%. That's nearly one-third more money flowing into global silver ore markets compared to the previous year. But here's the detail that should make you pause. The actual volume of silver ore China imported only grew 5.51%. Do the math on that discrepancy. China paid 31.46% more money to acquire just 5.51% more silver ore. That's a price surge of 24.71%. And Beijing absorbed every penny of that increase without hesitation, without negotiating better terms, without switching to alternative suppliers offering lower prices. You know what that tells us? China isn't buying silver because they've found a good deal. They're buying silver because they've decided they need it regardless of cost. The classic signature of strategic stockpiling, not opportunistic purchasing. According to customs data analyzed by commodity tracking firms, annualized growth projections show China's silver ore import spending could hit 27.18% increases as we move through 2025. While the trade war with the United States intensifies on tariffs, semiconductors, and technology exports, China quietly built a commanding position in the one market most Americans don't even know exists. Here's what makes China's position so powerful. They control 89% of global silver ore imports, not refined silver, not finished products. The actual raw material that gets processed into every application we just discussed. When Beijing decides they want more silver ore, they don't compete for it. They simply outbid everyone else and redirect global flows toward Chinese refineries. Think about that concentration of control for a moment. We just classified silver as critical to American national security, acknowledging we import 64% of what we need. Meanwhile, the country we're locked in an economic and technological competition with already controls nearly 90% of the raw material supply before it even gets refined. You're witnessing the same playbook China executed with rare earth elements starting in the 1990s. They recognized strategic materials before Western governments and companies understood their importance. They invested in production, refining, and processing, while we outsourced those dirty industrial operations to focus on cleaner service economies. Then, one day we woke up and realized China controlled the supply chains for materials essential to our defense systems, our consumer electronics, and our clean energy technologies. Now, they're running that exact same strategy with silver, except this time, the applications are even more critical, and the supply deficits are already here, not theoretical future scenarios we can plan around. But China's accumulation is only half the story. We need to understand what's happening on the demand side, because industrial consumption isn't just growing, it's accelerating past the point where traditional supply sources can respond. Industrial silver demand exceeded 1.2 billion ounces in 2024. Let me break down where all that material went, because the distribution tells you which technologies are actually reshaping our economy, rather than which ones simply generate headlines and hype. Electrical and electronics applications consume the largest share, and this category has exploded since 2016. We're talking about a 51% increase in just 8 years. Every data server, every switching station, every electrical contact point in increasingly complex electronic systems. They all need silver's unmatched conductivity to function reliably. The shift toward distributed computing and cloud infrastructure multiplied the number of physical servers processing information. Each server requires silver-coated components to handle electrical loads without degradation. Each networking switch connecting servers together depends on silver contacts for reliable signal transmission. Now layer on the AI revolution that began accelerating in 2022 and 2023. Training large language models requires massive computational infrastructure. We're talking about facilities housing tens of thousands of specialized processors running at full capacity for weeks or months at a time. According to projections from analysts tracking data center construction, AI infrastructure alone could add 5 to 10% to total industrial silver demand over the next 3 years. Every 500 megawatt AI data center and multiple facilities of that scale are either under construction or in planning stages right now requires approximately 300 metric tons of silver. That material goes into power distribution systems, ensuring stable electricity delivery, cooling infrastructure, managing the enormous heat these processors generate, and increasingly, solar arrays offsetting the tremendous energy consumption these facilities impose on local power grids. Tech companies aren't just building one or two of these facilities. Microsoft, Google, Amazon, Meta, they're all racing to expand AI capabilities, each company constructing multiple massive data centers simultaneously across different geographic regions to handle latency, redundancy, and legal requirements about data sovereignty. That's entirely new silver demand that didn't exist 5 years ago, stacked on top of everything else competing for supply. Then you have the solar sector, an industry locked into silver dependency by the fundamental physics of how photovoltaic cells work. Each solar panel requires approximately 20 grams of silver for the electrical contacts collecting and transmitting the current generated when sunlight hits the silicon. Engineers and materials scientists have tried for decades to find cheaper alternatives with comparable performance. They've managed to reduce silver content per panel by about 80% compared to early designs, but they hit a wall where further reductions compromise efficiency and reliability. Solar installations keep growing year after year as countries worldwide pursue clean energy targets, as utilities seek cheaper power generation, and as commercial facilities add rooftop arrays to reduce operating costs. According to the Solar Energy Industries Association, tracking U.S. installations, solar capacity is projected to double over the next 5 years, and every megawatt of capacity means thousands of panels, each one requiring its allocation of increasingly scarce silver. Electric vehicles represent another permanent drain on available supply. Each EV contains roughly 50 grams of silver spread throughout electrical systems, battery management components, and charging infrastructure. As global EV adoption accelerates, pushed by government mandates, consumer demand, and automotive manufacturers pivoting their entire product lines toward electrification, that's millions of additional vehicles annually requiring silver that won't be recycled for 15 or 20 years when those vehicles reach end of life. Even traditional automotive manufacturing increased its silver consumption as cars gained more electronic features, more safety systems, more connectivity. Your backup camera, your lane departure warning, your adaptive cruise control, all those systems require reliable electrical components using silver contacts. Medical devices represent another growing category most people never think about. Silver's antimicrobial properties make it irreplaceable in certain surgical instruments, wound dressings, and medical equipment where infection control is critical. As healthcare spending grows globally and populations age, medical silver demand rises steadily year over year. Now, here's the fundamental problem with all this accelerating industrial demand. The supply side can't respond the way traditional commodity markets typically work. Remember how I mentioned that over half of all silver comes from the ground as a byproduct? Let me explain why that matters so much. When copper prices rise, mining companies ramp up copper production. They run equipment longer hours, they open additional pit faces, they invest in expanding existing operations because higher prices make previously marginal deposits economically viable. That increased copper production naturally yields more silver as a byproduct. But the mining companies aren't responding to silver prices, they're responding to copper economics. So what happens when silver prices spike, but copper, zinc, and lead prices remain stable or even decline? Those mining operations produce the same amount of base metals they plan to extract, which yields the same amount of byproduct silver, regardless of how desperate electronics manufacturers or solar companies are for more supply. Primary silver mines, operations specifically targeting silver as their main product, could theoretically respond to higher prices by increasing production. But here's the reality. Developing new silver mines takes years, often close to a decade from initial discovery through production startup. First, you need exploration programs discovering viable deposits. Then geological surveys proving sufficient ore grades and tonnages to justify development. Then feasibility studies analyzing mining methods, processing requirements, and economic returns. Then comes the permitting process, and if you've paid attention to mining projects in recent years, environmental reviews and community consultations can drag on for years. After permits finally come through, you need financing, convincing investors or lenders to commit hundreds of millions or even billions of dollars to construct the mine, build processing facilities, establish tailings storage, develop infrastructure like roads and power lines, and cover all the startup costs before the first ounce of silver gets sold. Industry analysts tracking silver mine development timelines estimate addressing current supply imbalances through new mining projects could take the better part of a decade. That's not speculation or pessimism. That's based on historical timelines, from discovery through production for previous mining projects. Meanwhile, demand keeps accelerating. The market recorded a 149 million ounce deficit in 2024 alone. That means industrial consumption, government stockpiling, and investment demand together exceeded new mine supply by 149 million ounces that had to come from existing above-ground stocks, from recycling, or from investors liquidating holdings. Analysts expect 2025 to mark the fifth consecutive year of deficits, 5 straight years of the market consuming more silver than miners produce, 5 years of drawing down the accumulated inventory that took decades to build through previous periods of surplus. Think about what happens to any market that runs deficits year after year after year. Above-ground stocks get depleted. Available inventory shrinks. Price volatility increases as buyers compete for remaining supply. And eventually, if deficits persist long enough, you reach a point where physical shortages emerge, where buyers with money ready to spend simply cannot find sellers willing to part with their silver at any reasonable price. We saw glimpses of this dynamic during 2020 and 2021 when retail investment demand surged during the pandemic. Coin dealers ran out of inventory. Premiums, the amount buyers pay above spot price, spiked to unprecedented levels. Delivery delays stretched from days to weeks to months. Some dealers simply stopped taking orders because they couldn't source products to fulfill them. That was mostly retail demand, regular people buying coins and bars for investment or security. Imagine what happens when governments enter the market as major buyers with strategic mandates to build reserves regardless of price. When federal agencies have budgets measured in billions and purchasing programs that don't stop just because prices increased. The U.S. critical mineral designation did exactly that. Our government now has explicit authority and budgetary allocations to acquire strategic silver reserves. Those purchasing programs are now active, methodically accumulating the 75 million ounces that have already flowed into federal vaults. But we're not operating in isolation. Every major economy watches what America does and adjusts their own strategies accordingly. When we classified silver as critical, that sent a signal to other governments that maybe they should be securing their own silver supplies before scarcity becomes crisis. And here's the detail that should concern anyone paying attention to these markets. If China and the United States each decide to allocate just 10% of their strategic purchasing power to silver, not even their full budgets, just a fraction of what they could deploy, they could together absorb the entire 2025 surplus before any retail investor or small manufacturer ever gets the chance to buy. That's not speculation about what might happen in some distant future scenario. That's basic mathematics based on the purchasing power these governments command, the supply deficits already present in the market, and the strategic incentives pushing both nations towards securing critical materials before their geopolitical rival does. You're watching the early stages of a supply crisis unfold in real time. The question isn't whether physical shortages will emerge. The math already tells us they're inevitable. The question is how severe those shortages become, how quickly they arrive, and who gets caught holding dollars when they need to be holding silver instead. Let me walk you through the mathematics of what's about to happen, because once you see the numbers, you'll understand why this isn't a prediction. It's an inevitable conclusion based on simple arithmetic and strategic incentives that governments cannot ignore. We've already established that 800 million ounces have been erased from above-ground stocks since 2021. 5 consecutive years of deficits pulling down the accumulated inventory that took generations to build. That's nearly 1 full year of global silver production just gone, consumed by industries, absorbed by government stockpiling, programs, or locked away in private vaults by investors who understand what's coming. Now, governments are entering the market as competitors with industry for remaining supply. And here's where the math becomes unavoidable. If China and the United States each decide to allocate just 10% of their strategic purchasing power to building silver reserves, not even their full capacity, just 1/10 of what they could deploy if they truly committed to securing this critical mineral, they could together absorb the entire projected 2025 surplus before retail investors, small manufacturers, or technology companies ever get access to that material. Think about the strategic purchasing power we're discussing. The U.S. government can authorize billions in spending with a signature. China's State Administration of Foreign Exchange manages over $3 trillion in reserves and has demonstrated repeatedly that they'll deploy whatever capital necessary to secure strategic materials essential to their industrial base and military capabilities. When governments decide a material qualifies as critical to national security, budget constraints stop being the limiting factor. Political will becomes the only real constraint. And we've already seen both countries signal their political will through policy changes, designation classifications, and the purchasing programs already underway. You might be thinking, surely market prices would rise to balance supply and demand like Economics 101 teaches us? Higher prices should bring more supply and reduce demand until equilibrium gets restored, right? That's how commodity markets typically work. But silver isn't functioning as a typical commodity anymore. It's functioning as a strategic material where the largest buyers don't respond to price signals the way profit-maximizing companies do. When the Pentagon needs silver for defense systems, they don't negotiate for better prices. They pay whatever the market demands because mission capability cannot be compromised. When the Department of Energy pushes solar installations to meet clean energy mandates, they don't halt projects because silver got more expensive. They absorb the cost and continue deployment. When tech companies race to build AI infrastructure, believing their competitive survival depends on computational advantage, they don't pause data center construction over silver prices. They find the material and move forward. None of these buyers are price-sensitive in the traditional sense. They're mission-driven, mandate-driven, or competitive necessity-driven. Silver could double or triple in price, and their purchasing wouldn't slow down. It would simply transfer more wealth from buyers to sellers while the physical consumption continues unchanged. Meanwhile, on the supply side, we have already covered why new production can't respond quickly. Byproduct silver depends on base metal mining economics, not silver prices. Primary silver mines take the better part of a decade to develop. Recycling provides some additional supply, but recycled silver comes from products reaching end of life. And most modern electronics, solar panels, and EVs won't hit recycling streams for 15 or 20 years after installation. The supply is essentially fixed in the near term. Demand keeps accelerating. And now, the two largest economies in the world have both decided they need strategic silver reserves, creating government bids under the market that will persist regardless of price movements. That's the mathematical setup for a liquidity crisis. Not a short-term price spike that corrects when speculators take profits. A fundamental supply shortage where available material gets exhausted and buyers with money ready to spend simply cannot source the physical silver they need. Now, let's talk about what actually triggered all this, because understanding the catalyst helps you see why the timeline is compressed and why 2026 represents the convergence point where multiple trends collide simultaneously. Silver broke past $35 per ounce in mid-2025, posting a 25% year-to-date surge that got the attention of investors who remember previous bull markets. But here's what makes this move different from earlier price rallies. The critical mineral designation fundamentally changed the structural dynamics of our market. Previous silver bull runs in the 1970s, the early 2000s, and 2011 were driven primarily by investment demand, inflation concerns, or currency devaluation fears. Industrial demand existed, but investment flows dominated price action. When investment demand cooled, when inflation moderated, when currencies stabilized, when alternative investments looked more attractive, those capital flows reversed and silver prices retreated back toward production costs. But the August 2025 critical mineral designation created something that didn't exist during previous bull markets: a permanent government bid under the market. Federal stockpiling mandates now require agencies to build and maintain strategic reserves. Those purchasing programs don't stop when prices rise. They continue methodically accumulating target tonnages because national security objectives don't change based on market conditions. Permitting processes for domestic silver mining projects now get fast-tracked through expedited reviews. Projects that would have faced years of environmental studies and approval delays can now advance on compressed timelines under critical mineral provisions. That should eventually bring more domestic supply online. But remember those development timelines? We're still looking at years before new production actually starts flowing. Tax incentives now flow to companies developing American silver production, recycling operations, or alternative technologies reducing silver consumption. Those incentives make previously marginal projects economically viable and attract capital that might have gone elsewhere without the policy support. Put all those structural changes together, and you've fundamentally altered the market architecture. This isn't a cyclical commodity trade that reverses when sentiment changes. This is a strategic material where governments worldwide now recognize supply security as a national priority that requires permanent policy support and ongoing resource allocation. China demonstrated this exact approach with rare earth elements. Once Beijing recognized their strategic importance, they built systematic programs ensuring Chinese control over global supply chains. Prices rose, then stabilized at higher levels, but China maintained their accumulation programs through every price cycle because strategic objectives override profit maximization. We're seeing the same pattern emerge in silver markets right now. China's 31.46% spending increase on silver ore imports, while volumes grew only 5.51%, shows they're prioritizing access over cost. Our own government's 75 million ounce accumulation since August shows we're following the same strategic playbook, even though we're late to recognize the opportunity. And here's the detail that should focus your attention. We're running out of time before this window closes completely. The convergence point is 2026. Let me explain why that specific time frame matters. AI infrastructure spending continues accelerating at rates that surprise even the tech companies making the investments. Every major cloud provider, every AI startup that raised venture funding, every enterprise technology company, they're all racing to build computational capacity, believing their survival depends on AI capabilities. According to construction data from firms tracking data center development, the pipeline of announced projects would add 5 to 10% to total industrial silver demand if they all move forward on schedule. Solar installations worldwide maintain their growth trajectory, with each panel requiring approximately 20 grams of silver for electrical contacts. Global solar capacity projections show installations doubling over the next 5 years, which translates directly to doubled silver consumption from that sector alone, since engineers haven't found viable alternatives to silver's conductivity and reliability. And most critically, the U.S. appears ready to follow through on strategic stockpiling the same way we did with lithium and rare earth elements. When our government designated those materials as critical to national security, federal agencies systematically built reserves, supported domestic production, and ensured our military and manufacturers wouldn't face supply disruptions. Every indication suggests silver will receive the same treatment, probably more aggressively given how much further behind we are compared to China's established position. Now here's where the math gets stark. Industry analysts estimate somewhere between 300 and 400 million ounces of investable silver remains available in the market, material held by investors, dealers, and funds that could theoretically be sold if prices rise enough to incentivize liquidation. That sounds like a lot of silver until you run the numbers on how quickly that inventory could get absorbed. If AI infrastructure spending continues at current rates, that alone draws down 5 to 10% of total supply annually. If solar installations maintain their 20 grams per panel requirement and hit projected capacity targets, there's another significant permanent drain on available stocks. And if the U.S. follows through on strategic stockpiling even remotely comparable to what we've done with other critical minerals, federal purchasing, Programs could easily absorb 100 to 200 million ounces over the next 18 to 24 months. Layer on China's existing accumulation and programs that are already pulling material off the market. Add in India's growing industrial demand as their economy develops. Include the baseline industrial consumption from electronics, medical applications, automotive manufacturing, and everything else competing for supply. When you add up all those demand sources against the 300 to 400 million ounces of potentially available investable silver, you're looking at material that could vanish within 18 to 24 months under realistic scenario planning, not worst-case assumptions. Realistic projections based on announced projects, current policies, and strategic incentives that aren't going away. That timeline puts us into late 2026 or early 2027, before this window potentially closes, before the available supply gets locked up in government vaults, absorbed by industrial applications, or controlled by early investors who recognized what was happening and positioned themselves accordingly. You know what happens when a strategic material hits genuine scarcity? We've seen this movie before, most recently with the 1980 Hunt Brothers silver squeeze, though that situation had very different causes. In 1979 and 1980, the Hunt brothers accumulated massive silver positions through futures markets, attempting to corner the market through financial leverage. They pushed silver from $6 to $50 per ounce in just a few months before margin calls and regulatory intervention forced liquidation and prices crashed. But here's the critical difference between then and now. The Hunt brothers were speculators using borrowed money to manipulate prices artificially above fundamental values. They created a bubble that inevitably collapsed because their buying wasn't driven by genuine industrial demand or strategic necessity. What's developing now is the opposite situation. This isn't speculation or manipulation. This is fundamental supply-demand imbalance driven by irreversible technological trends, geopolitical competition for strategic resources, and governments recognizing they waited too long to secure materials essential to national security. When silver became scarce in 1980, prices crashed because the scarcity was artificial, created by market manipulation, not genuine shortage. When silver becomes scarce in 2026 or 2027, there's no speculative bubble to pop. There's just too many buyers with permanent needs competing for insufficient supply. That's when you see rationing scenarios emerge. When manufacturers call suppliers and get told they're on allocation, they can buy a percentage of what they need, but not their full requirements. When delivery times stretch from weeks to months because suppliers simply don't have inventory. When premiums explode because dealers charge whatever the market will bear for scarce physical material. We saw glimpses of these dynamics during 2020 to 2021 when retail investment demand surged during the pandemic. Coin dealers ran out of inventory, premiums spiked, delivery delays stretched absurdly long. Some dealers stopped taking orders entirely because they couldn't source products. Now imagine those conditions becoming permanent, not temporary. Imagine governments competing with industry and investors for whatever material remains available. Imagine China leveraging their control of 89% of silver ore imports to prioritize domestic needs over exports to the United States. That's not fear-mongering or doomsday prediction. That's straightforward analysis of mathematical realities, strategic incentives, and policy directions that are already underway and accelerating rather than reversing. So, what does this mean for you? If you're an investor watching these developments, you're witnessing one of those rare moments where government policy, technological trends, and supply-demand fundamentals all align in the same direction. The critical mineral designation wasn't symbolic. It was acknowledgement from the highest levels of our government that silver scarcity represents a genuine national security concern that requires immediate action. If you're someone concerned about protecting purchasing power, silver offers something unique in our current environment. Unlike currencies that governments can print in unlimited quantities, unlike bonds whose returns get eroded by inflation, unlike stocks vulnerable to market crashes, physical silver is finite material with irreplaceable industrial applications and strategic value that governments worldwide now recognize. The window for acting on this information is narrowing, not because of arbitrary deadlines or marketing pressure, but because the mathematics of supply and demand combined with government stockpiling. Mandates suggest available material will get absorbed faster than most people realize. You don't need to predict exactly when shortages emerge or how high prices might go. You just need to recognize that 800 million ounces have already vanished from above-ground stocks. Governments are now competing for remaining supply, and the technologies driving our future economy all require silver in quantities that existing supply cannot sustainably provide. The U.S. government's decision to classify silver as a critical mineral wasn't about protecting investors or helping precious metals markets. It was about protecting our industrial base, our defense capabilities, and our technological competitiveness in an increasingly dangerous world where strategic materials represent genuine power, and losing access to those materials represents genuine vulnerability. But here's the empowering part of this story. You have the same information now that governments used to make their August 25th decision. You can see the same supply deficits, the same demand growth, the same strategic competition playing out in real time. You can recognize what's happening and make your own informed decisions about positioning yourself before the rest of the market figures out what governments already know. The silver that disappeared into government vaults over the past few months tells you everything you need to know about what's coming next. The question isn't whether scarcity will arrive. The math makes that inevitable. The question is whether you'll be positioned ahead of it or scrambling to catch up after everyone else finally notices what you're seeing right now.